So what is DOM, depth of market? Well, the depth of market is a structure inside a chart where it takes place between three types of players: buyers, sellers, and market buyers and sellers. The DOM shows you a live sheet of all the buy and sell orders waiting to be filled at every price level on the chart. Think of it as a queue at the market. You can see exactly how many buyers and sellers are waiting at each price. You have your sell side at the ask and your buy orders at the bid and your current price at which it is trading. There are currently two sides to the DOM, the bid side and the ask side. The buyers are the people waiting to buy at a certain price. They are waiting, so it will not get filled until it finds a seller. A bid sits below the current price because price must fall to reach the buyers. The larger the bid, the stronger the support below because big buyers act like a floor. Over on the ask side are the sellers, the people willing to sell at a certain price. The ask sits above the current price because price must rise to reach sellers. The larger the ask, the stronger the resistance above because big sellers act like a ceiling. In simple terms, the bid or the buyers is the highest price the buyers are willing to pay for a share. They won't pay any more than the bid they have chosen. Ask or the sellers is the lowest price a seller is willing to take a share, and they will not sell for less than their ask. Now what about the gap in between the most recent seller and the most recent buyer with the smallest bid or ask? This is known as the spread. This is the equal distance between the nearest buyer and the nearest seller. Almost similar to ICT concepts, there is an imbalance. When it has a bullish imbalance, it means there are more buyers than are sellers, which means the price is likely to move up. Overall, on the bearish imbalance, that means there's more sellers in the market than buyers, which means the price is likely to go down. This is also known as a draw on liquidity for most traders. There are three beginner moves that often happen if you're good at spotting them. The first one is the wall, a massive order at one level blocking price from moving at all, acting as a ceiling and a floor. The second one is spoofing, fake large orders placed to trick traders and then pull. This often happens when orders vanish before price even reaches them. And absorption is when buyers and sellers become completely overwhelmed by their overcoming party. So how can you actually use the depth of market to trade? Well, there are a few different steps that you can take that might help you along your edge. First up, you need to look at the overall balance. If there are more bids than asks, the buyers are in control, so you might want to lean long because now you know you have a bullish bias. Secondly, you need to get good at spotting the big walls. This will give you insight on where your structure will be able to break. Thirdly, you need to know how fast orders are being eaten by absorption. This would help you know if you are falling into any type of trap. Look for a wall removal for your fourth step. A big wall disappears without price even reaching it. The order is most likely being cancelled, a possible fake move. If a big buy wall disappears without price falling to it, a bullish wall has been pulled, which means price may drop soon. These are things you need to look out for, as well as needing to combine the depth of market with your own chart setup. It does have its own limitations. Depth of market is best used for short-term and intraday trading, not for swing or position trades. Spoofed orders are very common when swing trading. Large orders disappear before even being filled or being misled by traders. Always use the depth of market alongside price action, never as your only signal. So how does the depth of market actually differ from a live price chart? Well, a price chart actually only shows the history of price movement. It shows where price has been and might go. You can form patterns from time to time, from all the way from minutes up to weeks. It's good for strategy and directional bias, and it's used by all traders of all types of time frames. A depth of market, on the other hand, shows only live orders waiting right now, who is willing to buy and sell at each level. Coupled with your chart analysis, this can be a very powerful tool because it updates every single millisecond. It's very good for entry timing and confirmation, and it's often used by scalpers and day traders mainly. If you want to learn more about depth of market and how traders work, check out the link in the description to my terminal. It's completely free and you can learn a bunch of stuff there, and as well as log your trades.